Hey, what's up guys? Real estate broker Michael Watkins here with Cashback Realty. And today what I want to talk about is what self-employed people and business owners need to do to buy a house.
Okay, boy, I'm beating my best, I know. Feeling the part, living my life, dancing, let's make some noise.
So to be honest with you, this topic was not on my radar at all right? I didn't realize it was so much of a big deal until I spoke to a client of mine. He's self-employed. We're working on his financing, his mortgage right now to get him pre-qualified, but there's so much misinformation out there that I felt like I had to make this video. I couldn't believe some of the things that his own accountant, his own tax guy, the person preparing his taxes, was telling him. So I had to make this video to set the record straight on a lot of misinformation and disinformation, quite frankly, that's out there. So one of the most common issues I come across with the self-employed is POI, right? Proof of income. Self-employed folks, like myself, have the luxury of being able to mitigate the amount of taxes we pay by writing off certain expenses, as well as flexibility with the amount of income you report. Now, here's what a lot of self-employed people end up doing. They go way overboard, and for years upon years, they'll write off too much, right? To the point where the amount of income that's reported in their tax returns is so low that they're not able to purchase a home, right? Like self-employed people, for some reason, the magic number seems to be $22,000 or $23,000 per year. That's the threshold where you find that you don't need to pay any taxes or very little taxes. And it seems like every self-employed person files that amount of taxes on their tax return. But then here's the thing. The only way $22,000 is gonna get you a house is if it's a $50,000 condo or something like that, all right? It's simply not enough income, especially here in South Florida, to buy a house at market value, right? The average house in South Florida is anywhere between $250,000 and $350,000. I'll use my current client as an example. So he's looking to buy about a $350,000 house. Let's say you're looking at a $300,000 house, right? You're gonna put down about 5% or so, which is $15,000. You need to qualify for a $285,000 mortgage, right? Principal, interest, taxes, and insurance on a mortgage like that is gonna be somewhere around $2,000, $2,200, depending on the interest rate, right? And it could be less, it could be more, guys, just bear with me here. Okay, so let's say you need to qualify for a $2,200 a month mortgage. The bank is gonna look at what's called DTI, debt to income ratio, right? What is that? Debt to income ratio measures your income versus the amount of debt that you have to pay every single month. And typically they like to stay around 50%. All right, so keep in mind, we've got a $2,200 mortgage that you're looking to qualify for. Let's say you have a car payment for $400. All right, now you're at $2,600 in debt. Let's say you have some other debt. Let's say it's credit cards. Let's say it's a student loan, whatever, right? Let's say you have another $400 in debt. All right, so we've got a $2,200 mortgage, $400 car payment, and another $400 in miscellaneous debt that you have to pay every month, credit cards, student loans, whatever. Now you're at $3,000 in debt that you're paying out every month, right? Remember what we said about where the bank wants you to be, 50%. So in other words, if they're not gonna exceed 50% of your income for debt, and you have $3,000 of debt that you're paying out every single month, what does your income need to be? For you math geniuses out there, you figured it out, right? You need to make $6,000 per month for you to qualify for that $2,200 a month mortgage, or in the scenario or example we're using now, a $300,000 home, right? You need to be making $6,000 per month, right? So what is $6,000 per month equal annually? $72,000 per year, all right? So now, think about it. As a business owner, you've been filing $22,000 per year, and really what you need to be reporting is a $72,000 per year annual income to be able to qualify for that mortgage. I know I'm throwing a lot of numbers at you here, guys, but you can always rewind this video, write the numbers down, and see what I'm talking about when you make the calculations. I just want to give you guys an idea of where you need to be. So what would that business owner need to do? you would need to go back and amend your income tax report to the IRS to show that you're making $72,000 a year. So what inevitably happens when you amend a tax return to show that you're making more income? You need to pay more taxes, and you're gonna end up having to owe the IRS back taxes. Now, don't panic. Don't panic. It's a common thing. People do this all the time. They amend their tax returns to either bring it down or increase it to show more income. Maybe they missed a write-off that they need to reduce their income. It's something that the IRS will help you out with, which brings me to my next point of the misinformation that this client was getting from his own accountant, which is that, oh, you shouldn't do that, it's not worth it, you're gonna need to pay the IRS immediately and they're gonna come after you. Not true, guys. That is complete misinformation, all right? The IRS, listen, unless you're some millionaire that's trying to evade taxes, the IRS is not, some hitman coming after you to get their money. Of course, they want you to pay your taxes, but they're gonna work with you, right? They have payment arrangements that they can set up for you, and they will set up for you to pay this money back. And number two, let's discuss the actual taxes, right? So you're probably saying, well, if I report $72,000 in income, how much taxes am I gonna owe to the IRS? Good question. You are gonna owe a significant amount more than what you did when you were reporting only 20 grand per year, right? Let's say you're in a 20% tax bracket. You're probably gonna owe somewhere around 15 to 20,000, depending on what you claim, if you have children, etc. Those are things that you should discuss with your accountant, all right? But you are gonna owe, a nice chunk, right? Which, to be honest with you, is what you should have been paying to begin with. But one of the things that my client was told was that, oh, it's not worth it. If you go back and amend 2 years, you're gonna owe $15,000 per year times 2, you're gonna owe the government about $30,000 or maybe $35,000 in taxes, and it's simply not worth it. And to that I say, well, what's the alternative if you wanna buy a house, right? If you wanna buy a house, this is a step, unless you somehow come into the money to buy the house cash, this is something that is inevitable. Right? If you're gonna go get a mortgage from a bank is gonna wanna see that you make enough money to make the mortgage payments. You're gonna need to show them income in the form of tax returns, right? And if you file income in the amount that's gonna, afford you the ability to pay the mortgage, you're gonna need to pay the taxes back. So when, clients get told, well, it's not worth it, you're gonna owe so much money in taxes, what's the alternative? So, I mentioned this, guys, only because it's one of the biggest hurdles that, I have to overcome when I'm explaining this to self-employed people who need to amend their taxes to qualify for a mortgage. They can't get over that hump of, I need to pay these back taxes to be able to qualify, and there's no way around it if you want to qualify for a mortgage. But here's another way to look at it, right? Chances are you've been renting for the past 2 or 3 years. Now let's take the average rent in South Florida, $1,600, right? You've been paying roughly $19,000 to $20,000 per year in rent, times 2 or 3, right? What is that, $50,000, $60,000 you've already thrown away in the form of rent, right? You weren't putting that money towards your own house or in the bank. That's money that you might as well just hold it out the window and let it go, because that's rent that you're never gonna get back, right? So that's number one. Number two, when you buy a house, that money is going towards your house, right? It's going towards building equity in property that you own, right? Not a landlord. So that's another plus right there. And number three, what's it worth, right? Let's talk about the intangibles. What's it worth to own your own home? To know that no one can ever evict you and put you out of that house, as long as you pay the mortgage, of course, right? But knowing that your family is safe, that's your house. That's a house that you can pass down to your children, right? It's something that's building equity, and not to mention also the equity in the form of appreciation that house is building year after year at an average of 3 to 5%. You would have probably gained about $20,000 or $30,000 in equity here in South Florida in a house that you bought 3 years ago. So you see, like, the argument that somehow not paying those taxes back to the IRS to be able to buy a house is not worth it, to me is just, it's ludicrous, right? I simply don't understand it. So guys, if you're one of those people like my current client that I'm working with to try to get him pre-qualified, where he's got great credit, he's got the money saved, he's got money down to put down on a house, and the only barrier to him buying a house is simply proving the income to the bank by amending his tax returns, you guys know where I stand on that. File your taxes, amend your taxes so you can qualify to buy a house. I tell every single person I know, if you have the ability to purchase a house and own property, do it. Don't forget to like, share, subscribe, guys. Hit that like button, hit that subscribe button, and share this with someone you know who might need the advice, who might need the information. Thank you for watching. Have a good day.